Let's start with the amount of costs that you put into the second quarter. You're really front-loading the, I think, $7.4 billion overall that the restructuring is going to cost you. How much do you expect to get out of the way in 2019?
So absolutely, we're working to execute on the restructuring just as quickly as we can, and with that execution comes the accounting recognition of the steps we've taken. This quarter, we're recognizing about $3.4 billion of costs associated with the transformation. Those are by and large non-cash charges, DTA impairments, goodwill impairments, and software intangibles that we're also impairing. So we get a good portion of the accounting impact already behind us in the second quarter. In the balance of the year, we're working now to take severance and restructuring charges in the second half as we execute on the restructuring. There'll be some real estate charges and some incremental DTA charges in the year. So we're expecting probably another $2 billion of these related charges over the coming several quarters, or 2 quarters in particular.
What percentage of the job cuts do you think you can get done in this year? I mean, clearly that's a huge portion of the cost. So
sure.
How many can you get out of the way?
Look, it's a steady, gradual process, and it's affecting pretty much all areas of the firm and all geographies. We're working as quickly as possible, but also trying to execute on this as sensitively as possible, given it's affecting the lives of our colleagues and friends. But we're acting just as quickly as we can. We've notified about 900 staff already associated principally with the equity sales and trading business that are either leaving or have left or leaving in near term the platform. The capital release unit is well underway in terms of execution on the deleveraging steps, organizing itself under a new management team, and also moving to, again, reduce the headcount associated with the businesses that we're either exiting or significantly reducing. So we're well advanced, frankly, for 2.5 weeks in, but it's a process that we now need to focus on and continue steadily for the next several quarters and, frankly, years.
But do you have a headcount idea, what target you want to hit for the end of 2019?
We have some internal targets, absolutely. And what we said externally was continue to be below 90,000. That's something we intend to achieve and hopefully go as deep into the high 80s as possible, but we don't want to give a specific target at this stage for a number of reasons. One thing that, as you may see going on, and we've talked about over time, was internalization. So we are continuing to internalize particularly technology jobs. And in the ongoing businesses, that type of activity will continue. So it's a bit of an ebb and flow, hence the reluctance to be pinned down on a very specific target number for the next couple of quarters.
You mentioned the equity sales and trading business. That was down 32%. The fixed income business was down only 4%. And those numbers, as big as they are, compare not so unfavorably to your peers on the street. Why did you do better than expected there?
I agree. So our FICC franchise actually performed quite well, I think, in the environment and relative to peers. That 4% is reported. It's about down 11% if you exclude the TradeWeb gain, which also a number of our peers had. And within that, frankly, rates performed reasonably, solidly. Our credit franchise was up year on year. And so we were quite encouraged, frankly, with the performance in many of our rates businesses, of our fixed income and currencies businesses. I will say, obviously, equities is down significantly. That reflects both the restructuring that we executed last year and also, as you'd expect, some of the uncertainty that played out during the quarter as the market and, frankly, clients and employees were anticipating some element of restructuring to come.